What if I told you that the greatest financial collapse of our generation won't begin with a stock market crash, a bank failure, or a recession, but with a number? A number so large, so monstrous, so dangerously misunderstood, that even the people creating it pretend it's not real. $38 trillion. That's the current US national debt. But here's the twist. The real danger isn't the debt itself. It's what happens when a single political decision turns that debt into a weapon. And in 2026, that weapon might finally fire. Because the global economy is now hanging between two forces: America's runaway debt crisis and Donald Trump's escalating tariffs on the world. One number, one policy, one global chain reaction. And when the chain snaps, everything that looks stable right now, your job, your currency, your savings, your investments, all begin to fall like dominoes. This is the story of how it all begins. Let's start with something uncomfortable. The US government is borrowing money faster than any country in modern history, faster than Greece before its collapse, faster than the UK after World War II, faster than any empire on record. Every second, the debt grows. Every election, it accelerates, and every year, the world pretends it's fine. But here's the secret: debt becomes dangerous only when trust breaks. As long as the world trusts the US government, as long as they believe America can pay its bills, as long as global trade keeps moving, the system holds. But the moment something shakes that trust even slightly, markets panic. And that is exactly where 2026 enters the picture. Imagine the global financial system like a dam. Behind it, trillions of dollars pushing, swelling, rising, pressure increasing every year. Debt, inflation, interest rates, geopolitical tension, all of it pressing against the dam wall. Now imagine someone walks up to that dam and starts hitting it with a hammer. Those hits, tariffs, and not just any tariffs, the biggest global tariff shock since the Great Depression. Trump's new tariffs aren't just political statements. They're not just negotiations. They're not even just punishments for imports. They are direct hits to a global system already cracking from debt. Tariffs increase prices. Prices increase inflation. Inflation increases interest rates. Higher interest rates increase debt payments. Higher debt payments accelerate a crash. This is the chain reaction experts fear, but rarely admit publicly. We are stepping into a moment unlike any in history, a world drowning in debt, a superpower struggling to pay interest, a global trade war heating up, a banking system still weakened from 2008, and elections creating more instability, not less. All these forces converge in one year, 2026, because 2026 is when the debt cycle and the tariff cycle meet. And when two crises collide, they don't add up, they multiply. The average person sees tariffs as simple: America wants to protect its jobs. China's taking manufacturing, tariffs will bring factories back. But behind the scenes, something far more dangerous is happening. Tariffs rewrite cash flows. Cash flows rewrite profits. Profits rewrite jobs. Jobs rewrite politics. Politics rewrites trust. And trust rewrites the entire global financial system. This is the untold part, the part missing from news headlines and political speeches. Every time a tariff is added, global supply chains shift, corporate debt rises, market volatility increases, foreign investors pull money out of us, bonds, dollar pressure grows, and the risk of a liquidity crisis rises. One tariff doesn't break the system, but dozens, hundreds, across trillions of dollars of global trade. Now the system begins to wobble. People assume the biggest risk from tariffs is inflation. Wrong. The biggest risk is debt rollover. Here's the secret Wall Street hates to explain. Every year, the US has to refinance trillions of dollars in old debt, like renewing a loan, except the loan amount is bigger than the economies of most countries. If interest rates stay high, the cost of refinancing becomes unbearable. If investors lose confidence, the US may struggle to sell its bonds. If tariffs push inflation higher, then interest rates stay high even longer. This is the danger zone, because if the US reaches a point where it must borrow money just to pay interest on old borrowing, the collapse becomes inevitable. And experts know this, they just don't say it out loud. Every financial collapse in history shares one thing in common: moments where people stop believing. Not when the debt becomes impossible, not when the economy slows, not when markets fall, but when people lose trust. And today, trust is eroding everywhere. Governments don't trust each other, corporations don't trust stability, investors don't trust the dollar, consumers don't trust prices, banks don't trust long-term lending. Supposed to be, but not this time. Because now even US bonds carry risk thanks to tariffs pushing inflation upward. And when the safest asset doesn't look safe, the world has nowhere to run. That's when panic truly begins. The next collapse hits the countries least prepared for it: Brazil, Turkey, Argentina, Pakistan, Nigeria, South Africa, Malaysia, Egypt, Indonesia, and dozens more. Here's why. When the US raises tariffs, the global supply chain cracks. When the supply chain cracks, commodity prices swing violently. When commodities swing, emerging markets lose stability. And when they lose stability, investors pull out instantly. Foreign money rushes out. Currencies collapse. Inflation jumps. Debt becomes unpayable. Countries beg the IMF for help. But the IMF is already overstretched. One market falls, then another, then another. What began as tariffs becomes a worldwide liquidity crisis, a drought of dollars. And since emerging markets depend on dollars, they drown first. All collapses follow a rhythm. First they start abroad, then they come home. By mid-2026, the signs are impossible to ignore. China is reducing its US debt exposure. Japan is raising its interest rates, buying fewer US bonds. Europe is in crisis mode. Emerging markets are imploding. Global investors are demanding higher yields. Inflation remains sticky because tariffs keep prices elevated. This combination hits the US bond market in its most vulnerable place, refinancing. The US doesn't borrow money once, it borrows constantly and rolls over old debt into new debt. But in 2026, refinancing becomes a nightmare. Because investors demand higher interest rates. Because inflation refuses to fall. Because tariffs keep prices rising. Because the dollar becomes unstable. Because trust is fading. Suddenly, to refinance even $1 trillion becomes expensive. But the US must refinance multiple trillions. The world starts asking one terrifying question. Can the United States really pay all this back? A question no one dared ask for decades. A question empires hate. A question markets fear. And that fear spreads. Behind the scenes, every major bank runs models for disaster scenarios. They don't publish them. They don't talk about them. They don't want anyone to see them. But one scenario was always considered impossible. A US bond crisis triggered by politics. Yet in 2026, this impossible scenario begins to look real. Here's what the models show. If global investors stop buying US bonds, if interest rates stay high because tariffs keep inflation alive, if emerging markets collapse, causing a dollar shortage if Europe faces recession, pulling money away from risk assets if China reduces bond purchases, if political conflict grows during election cycles, then the US could face its first real sovereign debt crisis. Not default, not bankruptcy, but something more subtle, more dangerous, a complete loss of confidence. And confidence is the foundation of all money. Once confidence cracks, everything collapses. In every crisis, investors run to safety. But 2026 creates a paradox. US bonds are risky, European bonds are unstable. Chinese bonds or political emerging markets are collapsing. Crypto is volatile. Gold is not liquid. Real estate is overpriced. Stocks are unpredictable. For the first time in modern history, there is no clear safe asset. And when there is nowhere safe to run, people start running out of the system. They pull money from markets. They hoard cash. They cut investments. They stop spending. And that reaction, the fear, the paralysis is what transforms an economic shock into a global collapse. Every financial crisis has a point. A moment where numbers stop being numbers and start becoming warnings. 2026 is that moment. Because for the first time in US history, America enters a place that economists feared for decades. A place known only by one name, the debt spiral. And once a country enters the spiral, there is no reversing it. Let us start with the truth every politician avoids. The United States no longer borrows money to grow. It borrows money to survive. Tax revenues aren't enough. Investment isn't enough. Productivity isn't enough. So the government borrows. But in 2026, something changes. The US begins borrowing money to pay the interest in the money it borrowed before. That is the definition of a debt spiral. It is the final stage before collapse. Because once a nation reaches that point, two things happen. Debt accelerates faster than the economy. No amount of growth can catch up. This is not a political issue. It's not left or right. It's not Trump or Biden. It's mathematics. And mathematics does not negotiate. Tariffs were marketed as protection. But in reality, tariffs behave like a hidden tax, a tax on goods, materials, manufacturing, shipping, consumers, and eventually the entire dollar itself. The average person feels it like this. Groceries cost 20% more, gas price jumps, rent increases, credit cards choke you, savings lose value, investments shrink, layoffs begin, fear spreads, people stop spending, businesses stop selling, banks stop lending, the economy stops moving, and that freeze is the final stage before collapse. Every great financial collapse begins with a single spark. In 2026, that spark comes quietly, almost invisible, until suddenly the entire world sees the inferno. It starts with a mid-sized American bank, not the largest, not the most famous, but heavily exposed to commercial real estate and US Treasury bonds. The bonds were once the safest asset in the world. Now they are poisoned by rising interest rates and the cascading effects of tariffs. The bank announces a liquidity crisis. Emergency meetings happen behind closed doors. Depositors panic, and within hours, the FDIC steps in. The public barely knows the name of this bank, but financial markets know the signal. If one bank holding us treasuries collapses, the others are next. This is the first giant falling, and it shakes the foundation of the US financial system. Within days, bank stocks plummet, bond yields spike, hedge funds begin liquidating risky positions, credit lines freeze, commercial lending halts. The first collapse triggers panic in the entire financial ecosystem. Banks stop trusting each other. Businesses cannot get loans. Consumers cannot borrow. A liquidity freeze spreads across the economy like wildfire. The system that once felt unshakable is now brittle, fragile, vulnerable. America's office spaces, malls, and hotels, already strained by years of declining occupancy, now implode. Buildings sit empty. Property values drop. Developers default. Banks holding these loans face massive losses. The second giant falls. Commercial real estate is no longer collateral. It's a liability. The ripple effect spreads through every connected business, every investor, every household. Then comes the unthinkable. A U.S. Treasury auction fails. Foreign governments and global investors hesitate. Demand falls. Yields spike. Bond prices collapse. The safe haven was debt is no longer safe. Banks and pension funds holding these treasuries instantly lose billions. The confidence that powered global finance for decades begins to crack. When the world doubts America's ability to borrow, the system entirely destabilizes. Wall Street braces for volatility. It gets annihilation. Within weeks, S&P 500 falls nearly 40%. Nasdaq drops even faster. Tech stocks bleeding billions. Hedge funds and leveraged investors are forced to sell at any price. Retail investors panic, selling positions they once held for years. No sector is safe. Stocks, bonds, real estate, and even crypto are collapsing in a domino effect. Bitcoin surges initially as a perceived safe asset, then plunges from 120,000 to 20,000 within months. Gold rallies slightly, then spikes as chaos pushes everyone to tangible assets. The world realizes the crisis is not contained, it's everywhere, all at once. Confidence in the dollar begins to erode. Foreign governments start diversifying away from U.S. assets. China reduces treasury holdings. Japan sells bonds aggressively. Europe hedges in euros. Middle East and emerging markets buy gold. The dollar falls 20% in months. Imports skyrocket in cost. Inflation surges. Interest payments spiral. America is caught in a perfect storm of tariffs, debt, and declining confidence. This is where the numbers meet reality. Unemployment spikes to 9%. Millions of jobs vanish. Retirement accounts are slashed by nearly 50%, wiping out decades of savings. Home values drop 20 to 30%, leaving millions underwater. Small businesses fail. Credit dries up. Commercial bankruptcies explode. The middle class is crushed. The wealthy survive, and the richest buy assets at fire sale prices. Social unrest rises. Protests, riots, political polarization intensify. The fabric of American society strains under the weight of financial collapse. The U.S. government tries emergency measures. Fed cuts rates slightly, but it's too late. Inflation is still high. Quantitative easing is deployed, pumping liquidity, but it weakens the dollar further. Fiscal stimulus packages are debated, passed slowly, ineffective against the scale of the crisis. Global markets respond violently. Every attempt to stabilize temporarily ignites panic elsewhere. The math cannot be ignored. $43 trillion debt. Interest consuming 30% of federal revenue, trade wars, cutting growth, tariffs, inflating costs, banks in freefall. Dollar losing reserve status. The system is beyond the point of easy recovery. The 2026 crash isn't about politics. It isn't about Trump, Biden, or any one individual. It's about structural imbalances, unmanageable debt, exploding interest costs, tariffs, and protectionist policies. Globalized markets reacting in lockstep, the illusion of safety in bonds and leveraged assets. And it teaches a harsh lesson. No empire, no system, no market survives ignoring math for decades. By the end of 2026, S&P 500 is down nearly 50% from its peak. Bitcoin has collapsed over 80%. Gold is the only shining safe asset. The dollar has lost 20% of its global purchasing power. Millions of Americans face economic devastation. Social and political stability is shaken. The world begins to reshape around new economic powers, away from dollar dominance. The final question isn't whether the crash happens. It already has. The real question is, will you survive it, or will you become part of the destruction?